Before we start, one thing has to be clear. The silver price most people see is not the real market. That price is set in paper markets, not by physical silver changing hands. As long as there is stress in the currency system, volatility in silver is not a warning. It's the mechanism. On Silver Forecast, we talk a lot about the thesis. You hear phrases like, midweek thesis check, the thesis is holding, or the thesis is being stress tested. And a lot of viewers have asked a fair question. What does the Silver Forecast thesis actually say is happening? Not emotionally, not philosophically, but structurally, especially right now, as analysts like Michael Oliver are talking about silver entering a new price reality over the next 6 months.
I think you'll see silver, with sharp sell-offs in the process, reach at least 200 and possibly a lot higher in a rampage. Yeah, there'll be a correction in the middle somewhere, probably.
That's what this video is about. When Michael Oliver talks about a new price reality, he's describing what price does after something breaks. He studies historical patterns. He studies momentum. He studies what happens once ceilings finally give way. What he openly says he does not focus on is what causes those ceilings to break. That's where the Silver Forecast thesis comes in. This is where a lot of people get confused. When they hear the word overbought, they immediately think speculation. They think too many traders, too much leverage, too much excitement. But that's not always what overbought means. There are actually two very different kinds of overbought markets. One is driven by leverage and speculation. The other is driven by real-world shortage. They can look similar on a chart, but they behave very differently. Silver right now is moving toward the second category. That's why we don't rely on RSI, and we don't anchor ourselves to moving averages. We watch delivery stress. So instead of traditional technical indicators, we focus on one simple question: is silver getting harder to obtain right now? That means we watch how much silver is being delivered versus how much is promised, how fast registered inventories are declining, and the spread between paper prices and physical availability. These signals don't tell us where silver should be trading. They tell us whether price will eventually need to rise high enough to slow demand. That difference matters. At this point, a lot of people bring up 2008, and that's a fair comparison to ask about. In 2008, silver was not in a supply deficit. Mine production was increasing. Above-ground inventory was adequate. Enforced liquidation and a rush to cash crushed price. Silver fell hard because there was plenty of silver available. That environment does not exist today. Today, the situation is very different. We now have multiple years where silver use exceeded production, registered inventories at multi-year lows, and industrial demand that cannot simply be postponed. You can delay buying jewelry, but you cannot run solar infrastructure without silver, operate EV charging networks without silver contacts, or replace failed industrial component without silver inputs. Silver has become a small but essential component of very large systems, and that changes how demand behaves. Naturally, the next question is, what happens if there's a recession? That's the right question to ask, but the answer depends on how governments respond. Today, global debt levels make prolonged tightening politically and economically unrealistic. A recession now is far more likely to bring rate cuts, liquidity injections, and fiscal stimulus, all of which tend to support hard assets. When supply is already tight, we also pay close attention to signs that the paper system itself is preparing for strain. Things like ETFs quietly changing redemption rules, futures curves flattening or moving toward backwardation, and large margin increases designed to cool delivery demand. These aren't technical signals, they're system signals. They tell you the market is thinking about delivery, not just price. There are also 3 real-time thresholds we watch closely, not as predictions, but as signs that behavior is changing. First, $82 silver. Multiple closes above that level tend to change how the market behaves. Second, registered COMEX inventory falling below 60 million ounces. When that happens while open interest stays elevated, delivery stress becomes visible. Third, a gold-to-silver ratio below 50-1. That tells us silver is no longer lagging. It's pulling the metals complex, including copper, higher. And when that happens, markets stop asking, what's the price? and start asking, can we get supply? When Michael Oliver talks about a new price reality, he's describing the result. The silver forecast thesis explains the cause, even pullbacks along the way. Do not break this structure. They often happen because fear clears before scarcity is fully recognized. This is not about timing tops. It's not about hype. It's about understanding why. Once physical limits matter more than paper promises, price must rise enough to balance a market that can no longer clear quietly. That's what we track week by week at Silver Forecast.